Thank you for joining us today. The following presentation is from a webinar titled A Pennsylvania Budget Overview, originally produced on July 18th, 2013. The presenter is Jason Skrinak with McKonly Asbury. Enjoy the presentation and visit us online at www.macpas.com for future events and webinars.
Thanks so much for attending the webinar this afternoon. We really appreciate your attendance. Brief introduction here. My name is Jason Skrinak. I'm a principal here with McKonly Asbury that head up our state and local tax practice. I've been practicing in state and local taxes now for about 15 years. I'm also chair of the PICPA State and Local Tax Committee. So a lot of this stuff that I'm going to be talking about today with regards to the budget is pretty near and dear to my heart. I was fortunate enough to be part of a working group that worked with the governor's office and the Department of Revenue to voice the concerns of the accountants out there with regards to some potential tax reform. So next, I'd like to go over the upcoming agenda for today's webinar. All right, we'll start off today by discussing the 2013-2014 Pennsylvania budget. Basic overview we'll start with, and then we'll go on to a more detailed examination of the tax components of the budget and the subsequent act that was recently passed, Act 52. And then we'll also discuss what we may see down the road as a result of what didn't make it into this budget, but still hot topics out there. And then we'll open it up at the end for any questions or concerns that you may have. All right, the PA budget highlights. The budget was basically $28.4 billion of state appropriations package. Of that, $645 million was an increase over the prior year budget. So the spending for Pennsylvania has increased about 2.3%. The three items that were getting the most press with regards to this past budget was pension reform, transportation, and liquor privatization. Surprisingly, they were 0 for 3 with regards to these three hot topics. That's not to say that these topics are dead, that they're not going to be addressed. They just didn't make it into this budget. They're definitely going to be hot topics going forward, and you're not going to hear the end of it. You're going to hear a lot more about these three issues coming up in the upcoming months. And finally, we'll talk about some corporate tax reforms with regards to the budget and previously stated the subsequent Act 52 that was passed. Provide a generic breakout of where the money's going. $9.9 billion of the budget spending is appropriated to the pre-K through 12th grade education. In addition, there's $1.6 billion for higher education funding. You'll see that that's over 40% of the budget appropriations is comprised specifically for education. You also go down the laundry list. You have $6.5 billion for medical assistance, $4.5 billion for welfare, $2.1 billion for corrections and parole, $11.2 billion for debt service, and the infamous $2.6 billion for other services. Some of the specific tax items that were included in the budget was funding for the continued modernization of the Department of Revenue. This has been going on for several years now. The actual funding this year dipped a little bit, but I think that the cause for that is the initial funding for the modernization. That's where a lot of the costs and expenses were associated with. So it's great to see that they're continued supporting the Department of Revenue, trying to get their computer systems up to speed. I think it will be a win-win at the end of the day for everyone. The Department of Revenue, tax professionals, as well as taxpayers. In addition, Governor Corbett has continually ran upon the notion of no new or increased taxes, and he's touting that again with regards to no tax increases on PA working families. There is no personal income tax rate increases at all. In addition, there is an elimination of the inheritance tax on small business. You'll see some of the requirements for which this elimination of the inheritance tax applies. Basically, it's for descendants passing on or after July 1st, 2013, so this year, and the business must be in existence for at least 5 years. In addition, the business must have fewer than 50 full-time employees. They must have a net book value of under $5 million, and the exemption does not apply for any entity whose business purpose is the management of investments and assets in which it owns. So they can they can manage investments and assets in other entities, but they can't just be doing their own investment. There's some discussion out there that this may create some problems down the road. There's a potential uniformity issue for Pennsylvania. For Pennsylvania purposes, it's provided in the Constitution that there shall be uniform treatment upon taxpayers of a same or similar class. So you're treating certain small family businesses different than, the family business down the street. If you have a full-time employees of 51 and the business right down the street has 49, the elimination of the inheritance tax applies to one and not the other. So there's potential there for some constitutional issues here for PA. In addition, you'll see here that there's the city revitalization and improvement zones. As everyone knows, tax folks and accountants in general love acronyms, so that's currently being referred to as CRIZ, C-R-I-Z. So just one more acronym for us to become familiar with. The city revitalization and improvement zones basically provides that certain tax payments to be funneled to zone development projects. There's going to be 2 cities with at least 30,000 residents in which they'll be allowed to create a CRIZ zone. See, I'm already starting to use the acronym. Some of the cities in which could be eligible for those 2 spots include Erie, Reading, Lancaster, Bethlehem, Altoona, Wilkes-Barre, Chester, and York. For those cities that don't have the initial CRIZ zone approved for their city, there's opportunities in the future. So beginning in 2016, 2 more cities each year may establish their own CRIZ zone. It's still very much in its infancy, so we're going to have greater direction from the Department of Community and Economic Development, another acronym, DCED. So these guidelines will be due by October 31st of this year, so there will be a lot more coming down the road to give us a better insight as to the process in which these cities can apply for these CRIZ zones. All right, so now we'll talk about some of the tax law changes specifically made through Act 52. We'll start off with the capital stock foreign franchise tax. I hate to say it, but I bought the Kool-Aid. I believe that the tax would be finally phased out this year, and 2014 it would be a dinosaur that would be out of existence. But I was proved wrong, so we have another continued phase out of the capital stock foreign franchise tax. The current phase out has been going on for over a decade now, so what's a couple more years among friends? So what we have here is that for 2014, it's not going to be no capital stock foreign franchise tax. They're actually going to decrease the tax rate. So instead of 0.89 mils that we have for this year, we're going to be looking at 0.67 mils for 2014 and 0.45 mils for 2015. And 2016, I'll be back telling you that the tax is now expired. One of the key components is that the tax rate for the cap stock foreign franchise tax at the end of the day won't be a 0 mil. It will be totally repealed from the books. So that's good news for us, because if the rate was just reduced to 0, they can always just increase the rate very easily, similar to how they're, phasing out the tax. They can easily jump the millage rate up from 0 to whatever they need to cover the budget deficit. So once the actual tax is repealed, it will be a lot harder for Pennsylvania to bring the tax back. Some of the other rationale as to why the phase out's going forward, everyone knows that Pennsylvania needed some additional money to balance the budget. They don't want to go through this headache again next year, so that's why you have the phase out for 2015 as well. Next year's budget is even going to be harder to pass because they're expecting a $1 billion budget deficit. So they're thinking ahead here, and they're trying to get some additional revenues in the door now for next budget season. And just so you know, these tax changes for under Act 52, a majority of these changes become effective 1/1 of 2014. So unless I say differently, you can kind of assume that that's the effective date for these changes. The next item we want to discuss this afternoon is the corporate net income tax changes. You'll see the first one there is intercompany intangible expense add-backs, and these will be effective for 2015. Basically, this is Pennsylvania's attempt to close the infamous Delaware intangible holding company loophole. That is where a special entity is created, usually in Delaware, but it can be in several other states, and the operating entity here in Pennsylvania normally moves their trademarks and trade names to that entity in Delaware, and they pay a royalty fee for the right to use these trademarks and trade names. For Pennsylvania purposes, they get the expense in calculating their corporate net income tax, and the revenue realized at Delaware for the royalties are not taxed here in Pennsylvania, and they're also not taxed in Delaware. There's a provision in Delaware in which those types of receipts are excluded from tax. So that closes the infamous intangible holding company loophole. There are some provisions with regards to the add back. The Act provides that there's a credit available if any of the disallowed expense for PA purposes was taxed elsewhere. So you're not going to be taxed on over 100% on those intercompany transactions. In addition, there's a specific exemption or exception if a transaction's primary business purpose is not the avoidance of tax, and that specific transaction was done at an arm's length. So if you meet those two criteria, you have to meet both of them. It has to be at an arm's length transaction, and it has to be for a primary business purpose other than the avoidance of taxation. You might be able to meet that exception. I'm currently trying to figure out the specific nuances of the credit provisions and what does and what does not meet the business purpose and arm's length transaction, but that'll be something that we see going forward. We'll be just discussing that in a lot greater detail, I'm sure. The next area is the sales factor. Pennsylvania is now 100% sales factor for corporate net income tax purposes. However, it's pretty easy with regards to the sales factor when you're dealing with tangible personal property. You're going to have Pennsylvania sales whenever you sell tangible personal property to a customer here in Pennsylvania. However, it got a little murky there with regards to sales of services. In years prior, sourcing of services for the sales factor was done based upon a cost of performance. So if your greater cost of performing a specific service was found here in Pennsylvania, Pennsylvania would have that entire service revenue sourced here. If the greater cost of performance was performed outside Pennsylvania, Pennsylvania would get zero. They would get none of that service fee revenue. In practice, it didn't really work out that way, and in practice, there was a very hard determination of what was the actual cost of performing a service. So there's a lot of back and forth with regards to what tax practitioners wanted and what the Department of Revenue wanted. We were hoping to get regulations for many years to kind of give us a better guideline as to what the calculation for cost of performance was. But now we really don't have to worry about that with regards to sales of services. However, we still have to worry about cost of performance with regards to intangible revenues. So I don't want to go too deep into that, but just for the sales of services, we're now basically at a market sourcing. So wherever the services are being delivered, that's where the revenue goes. If you have a service that's being used both within Pennsylvania and outside Pennsylvania, you basically take a percentage of that service that benefit is here in Pennsylvania. Next item I'm going to discuss is the net operating loss deductions. That was one item that kind of got through the whole budget process unscathed. 2013, we're looking at $3 million or 20% of taxable income, whichever's greater. 2014, they're increasing that to $4 million and 25% of taxable income. And 2015, $5 million or 30% of taxable income, whichever's greater. The the non-filer penalty is also established here with a minimum $500 penalty. That's for the failure to file a report for corporate net income tax purposes or knowingly filing a false report for corporate net income tax. That minimum dollar can increase pretty quickly too. If any tax liability over $25,000, there's an additional 1% non-filer fee penalty. Next up is sales and use tax. Not too much new with regards to sales and use tax. There's a couple changes here and there. The first one you'll see is the new exclusion for fixed wing aircraft repairs and maintenance. From what I heard, the reason for this exemption is to try to limit those folks with airplanes going outside Pennsylvania to get the repairs on their planes. Some states already had this exemption, so there's some thought that individuals and companies would send their planes out of state to get the repairs needed as opposed to having it here in PA and paying the tax. There was some discussion that possibly exempting the purchase of any planes here in Pennsylvania, but that didn't get as far as the actual exemption that made it through. I find it kind of interesting that, the aircraft and helicopters are getting these preferential exemptions for sales and use tax purposes. Unfortunately, I'm not able to take advantage of these breaks. All right, the next area is the shortened appeal period for sales tax revocation. That's basically stating that those individuals operating their business without a valid sales and use tax license, for some reason their sales and use tax license was revoked. There's a shorter time period in which they can go back and appeal and get their license back. The rationale was you don't really want these individuals that don't have the best reputation, that are kind of doing things on the fringe of the law to be able to go those extra 60 days. Some of the thought too was you can kind of prevent some crime there as well. When I say crime, some of these folks were operating without a license. They were still charging the sales tax, and they were still collecting the sales tax. They forgot the most important part, though, and that's the remission of the sales tax. So basically, that's deemed a felony here in Pennsylvania. You can't do that, and that's just like stealing 6%. In some places, some parts of Pennsylvania, it's actually 8%, as we'll discuss in a little bit. You also see here that the call center tax credit was repealed. I don't know much about it. I'm not sure many people knew much about it because no one ever really used this credit. You'll see that there's a lot of repealing of credits, a lot of taking out certain unused language in the statutes here in Pennsylvania. That was another goal and objective that we thought was a great idea for Pennsylvania to kind of tighten up their statutes and kind of get rid of those statutes that really don't apply anymore. Try to reduce it to a bearable, amount of volumes. I'm not sure if they did it because they got rid of a lot of good stuff, but they actually added a lot more stuff. So at the end of the day, the statutes may have increased size. They also provided in the Act 52, they wanted a Federal Marketplace Fairness Act report. Basically, Pennsylvania wanted to be ready and have all their ducks in a row in order to be able to act upon any federal mandate with regards to remote sale legislation. The Federal Marketplace Fairness Act got a lot of notoriety, got a lot of attention across the nation. There's call up in arms of people saying that, see, they're trying to tax us again. They're adding more taxes on us. That's really not the case. There's always been use tax to coincide with the sales tax. So if you're placing an order with, say, Amazon or any online retailer, and they're not charging you a sales tax, if that item was taxable in your state, you should have been self-remitting a use tax. So this wasn't a new tax. It was just a new methodology in which the tax could be collected. So not really sure how far the Federal Marketplace Fairness Act will go. I'm not really too confident that it'll get much legs. Everything I'm hearing is that it's not getting the support it would need to finally pass and provide that online retailers would be forced to collect sales tax and remit it to the various states in which they're selling into. So that's kind of a wait and see, but there's some language in Act 55 that provides that a report must be prepared. So Pennsylvania will be ready and able to plan accordingly if that specific act or any act similar to that deals with online remote sellers passes. There's also removing of the sunset of the additional 1% use tax for Philadelphia. Philadelphia originally, like Allegheny County, had a 1% local tax in addition to Pennsylvania's 6% tax rate. That wasn't enough for Philadelphia, so they bumped it up another 1%, but it was set to phase out, June 30th of 2014. So they saw that date coming up, and they didn't like the idea of going back to 7. So they removed the sunset, so Philadelphia is still an 8% tax rate. All right, and some of the personal income tax changes associated with Act 52. They're trying to get Pennsylvania to be more along the lines of some of the federal programs out there. So for pass-through entities, there's a $5,000 startup business deduction that's available for federal purposes. So basically, if you meet the requirements for federal purposes, you can get the $5,000 deduction for PA purposes for a pass-through entity. Pennsylvania also eliminated the resident credit for taxes paid to foreign countries. A lot of people got concerned. They saw the elimination of resident credit for taxes paid, but didn't read on with regards to the foreign countries. The resident credit for taxes paid to other states is still out there and totally valid. But for those taxes paid to foreign countries, they're eliminating that credit. That's another area in which we may have some constitutional issues with regards to discrimination of foreign commerce. So kind of waiting here on that. I'm sure someone that's going to get hit pretty heftily in the wallet may want to take this change up and argue it through the court system. There's also an allowance for the expensing of intangible drilling costs. This is specifically associated with the Marcellus Shale boom to the industry with regards to drilling for natural gas here in Pennsylvania. Don't know 100%, but basically when I'm reading, it's about a third of the cost can be expensed in year one, and the remaining dollar value of those expenses can be amortized over a 10-year period. And that's an election that the taxpayers behalf. So we'll see how I'm sure there'll be a new form or something they have to check for PA purposes. But they're definitely trying to make it more attractive for individuals and companies to come here in PA and spend as much money as they can while drilling these natural gas. Next up is the personal income tax checkoffs. I apologize, I did another acronym there. PIT's personal income tax. They basically expanded the use of the wildlife conservation, the organ and tissue donor program, and the military family program. If you recall looking at your PA individual return, there were boxes that you could check to contribute money to or have part of your refunds go to one of these three entities. They're set to be terminated and moved off the return, but the act here continued the life of these three entities with regards to being able to transfer money to these entities or donate money to these organizations. In addition, those three that were saved, they've actually added two new line items. You can now donate money or designate part of your refunds to go to the Children's Trust Fund or to the American Red Cross. Not sure how well this went over with regards to those folks preparing the returns, the actual forms to be used, because you got a lot more line items now. So you got 5 PIT checkoffs, and you have the individual use tax line item. There's a lot more lines on the PA return, but that being said, they always seem to make out and make it work, so I have no doubts that they'll do the same this year. Next is the authorization of assessment of tax at the entity level in certain cases for pass-throughs. Basically, what that is saying is that if you have underreported income of more than $1 million and your entity has at least 11 or more partners, that tax assessment can be made upon the entity as opposed to trickling it down to the individuals through the flow-through. This is actually pretty convenient when it comes to appealing these assessments. So as opposed to having, say you have 100 partners in a firm and the firm gets dinged up for $1 million of tax, prior you'd have to file 100 different individual appeals at the Board of Appeals, and each individual would be arguing their case separately. Basically, now you can actually have it done at the entity level. So you just have one appeal at the entity level in which to resolve the issue. Like I said, it avoids numerous individual appeals in cases like that. In addition, individual partners are entitled to a credit made by the payment made by the entity, and the individual partner may also seek a refund if the tax would not have been owed to them for some unknown reason. So basically that's saying if the entity, the pass-through, agrees with the assessment and pays the tax, but there's an individual partner within the firm that really thinks that assessment should not apply to them, they can appeal on their own, separate and apart from the entity. The next part of Act 52, which is very near and dear to my heart, is with regards to the Board of Finance and Revenue Reform. This all came about, well, I shouldn't say just came about. It's been coming along for years, decades, that folks thought the Board of Finance and Revenue wasn't the most fair way in which taxpayers can get their case heard and get a decision. Recently, the last Council of State Taxation graded Pennsylvania a D for the administrative appeals process. Pennsylvania has been doing a great job of moving in the right direction. Last year, they've actually provided that during corporate audits or sales and use tax audits, that abatement of penalties may be granted at the audit level, where in years past that was never the case. So that was great. Actually had a couple clients that were able to use that provision, and it saved a lot of time and effort on the taxpayer's behalf, and actually a lot of time and effort on the state's behalf as well, since they didn't have to hear the case, they didn't have to have hearings on these cases. So I thought that was a great alternative. In addition, Pennsylvania's Board of Appeals now provides that you can have compromise abilities. And this is another area where several of my clients have been had great success. You can come in and say, basically, here's my case. I think I have a great case, but I don't want to go through the time and effort of arguing, knowing that it'll probably have to go up to Board of Finance and Revenue and maybe possibly up to the Commonwealth Court. So I'd rather try to get this done at the Board of Appeals level and say offer a compromise of 60 cents on the dollar. Pennsylvania may realize that these cases are being compromised at Commonwealth Court at the same rates at 60 cents on the dollar. So Board of Appeals could potentially say, fine, we'll compromise at 60 cents on the dollar. Everyone walks away. The taxpayer has resolution. The Commonwealth of Pennsylvania has dollars in their pocket a lot sooner than if it went through the whole appeal process. A lot of the goals with regards to administrative appeal changes is to resolve items more quickly for everyone's behalf. There's a lot of money out there that's just up in limbo, and Pennsylvania can't get it until these cases are resolved. For those of you who are not familiar with the administrative appeals process, it basically goes originally to the Board of Appeals. From there, it can be appealed up to the Board of Finance and Revenue. And if there is still dissatisfaction, then it could be taken up to Commonwealth Court, which is the first time that it's in the court systems. And at that point, I kind of have to step away and let the attorneys handle that. But most of the cases that actually get up to Commonwealth Court are never heard before a judge. Most of these cases are actually compromised. So what you have here in worst case scenario is you have an issue brought up, the taxpayer is assessed, they go forward, file with Board of Appeals, get denied, go to Board of Finance and Revenue, get denied, and get up to Commonwealth Court where they reach an agreement, say a 50% on the dollar agreement. If it's a repeating issue, so every year they're going to have the same set of facts, the same exact issue, they'd have to go through the whole process again for every tax year. They would have to go through the Board of Appeals, Board of Finance and Revenue, Commonwealth Court. Now that we have the compromise, we can actually get this done a lot sooner. So we can actually get the same compromise that was originally received at Commonwealth Court and get that a lot sooner at the Board of Appeals. Kind of went off on a tangent there, but like I said, I think PA is moving in the right direction. And this definitely helps with regards to the reform of the Board of Finance and Revenue. Amazingly, there is no resistance whatsoever when talking to the various parties. It was bipartisan support for this. We spoke to the Treasurer's Office, who had a lot of say and a lot of great ideas with regards to how to form this. Spoke to the Department of Revenue numerous times. Worked with the Governor's Office, spoke to the Attorney General's Office, the Auditor General's Office, the actual Auditor General himself. And through the whole process, it was very open, very frank discussions, and everyone seemed, at the end of the day, to want to do what was right and what was in the best light for the taxpayer. So we actually got this reform. So give you a little taste as to what the reform includes. We still have the Board of Finance and Revenue. The actual board now is going to be reduced from a 6-member board to a 3-member board. A lot of taxpayers and taxpayer representatives thought it was an uphill battle with the current board structure. Main reason was that there was a Department of Revenue representative on the board. So the same department that decided what the tax liability was, And if there was an issue or there was not an issue, they decided, here's what the tax liability is. They're now also involved in determining whether they were correct or incorrect in that initial analysis. So we kind of thought that was not very independent with regards to having the Department of Revenue representative on the board. In addition, the Attorney General had a seat on the board. This just seemed very unjust as well, because if the case was to be taken forward to Commonwealth Court, who's going to represent Pennsylvania in the matter? It's going to be the Attorney General's office. So a lot of the times the Attorney General would recuse themselves from making a decision at the Board of Finance and Revenue. And he also had the Auditor General on the board, and they also have some say and some input with regards to corporate assessments. So what we were actually able to do is get a more independent board. So instead of the 6-person board that, this was in addition to their other jobs in which they had with their various departments, we now have a 3-person board whose job, this is a full-time job for them. We have a treasurer representative that's on the board, and then we have 2 appointed individuals that are appointed by the governor and confirmed by the Senate. These individuals will have a 6-year term. The first go around, once these individuals are appointed, there might be I think there is a 4-year term for one of the appointments, just so there's a staggered period in which you're not going to have 2 members of the board coming up for reappointment in the same year. I really think this provides for greater independence. Like I said before, these individuals, their full-time job is to be part of this board. It's their sole responsibility. These individuals that are on the board, they are required to have specific experience. They're required to be a CPA or an attorney and have 10 years of experience in Pennsylvania tax issues. The one nice thing, too, is other than the actual composition of the board, a lot of the same tried and true procedures are still going to be followed at the Board of Finance and Revenue. So it's still going to be done, the hearings are going to be done in the same venue. The only thing is you're not going to be presenting to the 6-person board. You're going to present to a 3-person board. And then the Department of Revenue will also have a representative presenting their side. So I think it'll be a lot more fair and independent. The one thing I definitely think we'll have is a lot of more transparency with regards to the issues being resolved. The Act provides that decisions must be published on a website. And that includes dissenting opinions. So if you have something that comes down 2-1 vote, you still get to hear what the one individual is basing their vote on. And in addition, these hearings are still going to be public like they currently are at the Board of Finance and Revenue. So all in all, I think it's a great win. The one nice thing, too, is taxpayers can represent themselves before the Board of Finance and Revenue, or they have the option of having a CPA like myself, or they can have an attorney represent them before the Board of Finance and Revenue, or they can also have other designated representative present their arguments. And finally, with regards to the BF&R reform, it also provides a compromise authority at the Board of Finance and Revenue. So it's nice having various levels in which you can get a compromise and get something done in a greater, more efficient methodology. All right, up next is the bank shares tax. Used to deal with the bank shares tax a lot more, probably 10, 12 years ago. Don't deal with it too much anymore. However, there's now a change to the calculation of the tax. The change of the calculation is kind of twofold. One being, you'll see that they're changing. Well, actually, we'll just go over the changes, and I'll give you the rationale as to why I think these changes are needed. There's an adjustment of the rates from 1.25% to a 0.89% of the bank's total equity capital. They now have a new one-year valuation formula. Prior, it was a 6-year average valuation formula. And lastly, it is now a single sales factor, very similar to the corporate net income tax single sales factor. So basically what we had here was, with the economy the way it was, regulators were requiring banks to maintain additional capital. So just raising the capital requirements of the banks automatically increased the tax for bank shares tax purposes. So that's kind of where you see the adjustment of the rate from a 1.25 down to a 0.89%. It's not cutting the banks much of a break. It's actually just trying to get them back on level footing. This was all supposed to be revenue neutral, so they just basically want to make sure that the banks aren't getting clobbered by having the regulators requiring additional capital. Next is the new one-year valuation formula. Like I said before, prior it was a 6-year average for the valuation formula. However, there's a case out there, actually there's been a couple cases with regards to mergers. If you had a merger with two banks, both subject to the bank shares tax, they would basically just add together the valuation of the two banks and tax the entity based upon that. So they would take both banks for the 6-year period, lump them together, and come up with their formula. However, if you have one bank merging into another bank, and the one bank is outside of PA and not subject to the PA bank shares tax, you don't merge those two entities when coming up with the valuation formula. So this new one-year valuation formula provides a way around the lawsuit out there, the actual court case out there. So a little more ability for banks to have a better idea of what the tax liability will be at the end of the day. And the next area is the single receipts factor. I may have something to do with that. There is some planning opportunities that some banks were using with regards to some apportionment play for the bank shares tax. Pennsylvania found out about this. Wasn't much they can do because everything that was done was, according to the letter of the law of PA, it just reduced the entity's bank shares tax. So going to a single receipts factor kind of did away with that planning opportunity going forward. Another thing with regards to the bank shares tax changes, there's some expansion as to who can be taxed in PA. It looks like they're trying to pull in some non-bank shares filers into PA. So some banks outside of PA, potentially have some customers here in PA, maybe doing some kind of transactions, maybe dipping their toe into the waters of PA. Pennsylvania wants a cut of that as well. So it'll be interesting to see how that shapes up. So I talked about some planning opportunities with regards to the bank shares tax that Pennsylvania got rid of. Here's one that I had no responsibility for whatsoever. The realty transfer tax, they provided that they closed a loophole referred to as the 8911 loophole. This was based upon planning opportunities in which they provide a structure with regards to a real estate transaction to avoid the realty transfer tax. I'm not sure the specifics. I was never involved in that, so I can't be blamed for that one. But that has been changed, and that loophole is now closed. So you can't get out of the realty transfer tax now. Now for some of the credits associated with Act 55. First credit's the Mobile Telecom Broadband Investment Tax Credit. If there's any credit out there screaming for an acronym, I think it's that one. I just can't seem to come up with one. The MTBITC is almost as bad as the actual credit name itself. It's a $5 million annual limitation on this credit, and it's provided for tax years 2014 through 2024, specifically for the corporate net income tax. The credit is equal to 5% of the annual investment in broadband equipment being purchased in a taxable year. And you cannot use you can't use a credit that would reduce your liability more than 50%. Don't have many telecommunications clients. I don't get too involved in that, so I'm not sure if that's going to have much impact on my day-to-day life. A credit that will have even less impact on my day-to-day life is the Innovate and PA tax credit. I've seen it basically referred to as Pennsylvania borrowing funds for development by basically auctioning off insurance premiums tax credits for subsequent years. If I haven't done too much digging into that credit yet. I don't plan to really do much digging into that credit, but if someone has a specific question or concern about that, please let me know, and I can get back to you. Or maybe I probably don't want to be stumped at the end when I go over the question segment, so maybe I'll take any questions offline with regards to any of these credits that someone has a specific question on. There's an amendment for the films tax credit. It basically limits the carryover of an assigned credit. I'm not going to go into too much detail as to my thoughts on the film tax credit. I did that last year at a conference, and there was someone from the film industry, so I kind of got reprimanded on what I had to say, so I'm going to avoid that one as well. We have amendments to the Education Opportunity Scholarship Credit. Basically, the amendment here allows that a student can continue to receive a scholarship even after their school is removed from the list of low-achieving schools. So if you remember, this credit is basically for students attending lower-achieving schools. If their school hit the list and they're eligible, they could obtain basically a scholarship to go to a new school. This is basically saying that if their original school somehow gets off the list, that they're not just going to pull the scholarship, that they will still have their scholarship going forward. I believe it's for a 5-year period after the school gets off the list. So that's actually kind of nice, so they don't just pull the rug out from someone. Next one is the repealing the coal waste removal and ultra clean fuels tax credit. That is one that I don't think it was ever touched. So there's a bunch of credits out there that they were so specific, and you had to meet specific requirements that no one met them, and no one took advantage of these credits. So they wanted to clean things up. Next is the Jobs Creation Tax Credit. The actual amount of credits available were increased under this Act 52. So we went through everything that was done with regards to Act 52. Now I just kind of want to go back and revisit what wasn't done. The original budget proposal included some topics that didn't make the cut. The first and foremost is the corporate net income tax rate reduction. It was thought that the rate reduction would go hand in hand with the the affiliated entity expense add back. The thought was, we're going to reduce the rate, get rid of the intangible holding company play, and at the end of the day, taxpayers here in PA will still be in a similar boat. And it would also have been helpful too for Pennsylvania, I think, to attract and to promote business here in the state, since Pennsylvania's 9.99 corporate net income tax rate is still the largest flat tax on corporate net income. Other states do have a graduated rate that go above Pennsylvania's 9.99. I believe Iowa is at 12% at a graduated rate. But for a lot of businesses, if it's between Pennsylvania and another state and they see Pennsylvania's 9.99 tax rate, it's not even a thought process. They just shut the door on the opportunity of coming into PA and go to another state. The rate reduction was scheduled to go from 2015 to 2025. So there was another, instead of a phase out like the capital stock, it was a phase in or a phase back of the actual tax rate. So kind of disappointed that the rate reduction didn't happen, but like I said before, next year's budget is not going to be pretty. So I think that they saw that coming down the pipe and they just wanted to not even deal with it next year. So they just pulled the plug on that. already discussed the elimination of the capital stock foreign franchise tax in 2014. That's not going to happen now until at the earliest 2016. Some taxpayers out there view that as a nuisance tax, and they're saying they're being taxed twice for doing business here in PA. I'm kind of indifferent to the capital stock foreign franchise tax. I think it's a decent revenue raiser for Pennsylvania because it gives them a steady flow, and they can project a lot better based upon the tax calculation. One of the components is the net worth of an entity and an average value of their book income. So it's a more of a flat kind of tax. Not really flat, but they have a better idea as to what the expected revenues are with that tax, as opposed to the corporate net income tax, where, based on the economy, you could have wild fluctuations. Another thing that didn't make the cut was like-kind exchanges. There is some thought that similar to the $5,000 deduction for new businesses here in PA for pass-through entities, there is the thought that they can get like-kind exchanges that are similar to the federal rules. Basically, a like-kind exchange is if you sell a piece of business equipment, you realize a gain on that equipment, you can defer that gain if you take the proceeds and actually buy a similar piece of equipment, as opposed to paying the tax up front and then paying the tax again once you get rid of the replacement equipment. So those are a couple things that didn't make the cut. Like I said before, the corporate net income tax rate, I was kind of disappointed with. I think that would have gone a long way in promoting Pennsylvania as a good place to work. Keep companies here that are currently here and hopefully attract new business, but it wasn't to be. All right, we're in the home stretch here, so now I'm going to discuss the probable tax legislation. This is with regards to the Fiscal Code Bill, Senate Bill 591. These are some more tax implications. They weren't in the Tax Reform Code, they're in the Fiscal Code, so they're under a separate bill. Basically, should be done anytime now. Hopefully, knock on wood, this should be done anytime now. The main part of this bill that I love is repealing the corporate loans tax, and that would be effective for 1/1/2014. Entities are not only subject to the corporate net income tax, the capital stock foreign franchise tax, but they're also subject to the corporate loans tax. It's a very outdated tax, and I think it's going to save a lot of time, effort, and headaches going forward repealing that tax. So I'd like to give kudos with regards to that. Next up is electronic fund transfers required for payments of $1,000. Previously, this was required upon payments of $10,000 or more. They're trying to, go more modern age, more streamlined, and have any payments of $1,000 or more being done electronically. They're also looking to require mandatory e-filing of returns for third-party preparers, and they're reducing that for preparers preparing 50 returns are now required to file all the returns via electronic format. They're trying to reduce that down to 10. So if you have a third-party preparer preparing 10 returns, they must e-file with Pennsylvania. That's very similar to federal standards. The next one is enhanced collections account extended to increased tax enforcement. They actually have monies specifically set aside for the folks at Revenue to go out there and collect revenues that they're rightfully due. I was talking to some folks over at Revenue, and this is actually a great return on investment. I don't know the exact dollar figures, but I was floored when I found out how much money is specifically designated for this as opposed to how much money is brought in based upon those efforts. It was staggering, basically going after entities that should be filing here in Pennsylvania, also based on taxpayers that have a liability with Pennsylvania, but with increased enforcement, they can actually pull those revenues into the coffers. So I was glad to see that as well. Another thing with regards to the fiscal code makeup is the prohibition of contingent fee audits contracted out to third parties. This kind of scared me when I heard that Pennsylvania was kind of looking into this. Some other states currently go out and have third-party auditors go out and audit taxpayers. So basically, they get a fee based upon the amount of tax dollars on which they assess. If you think about it, there's really no reason for a third-party contracted auditor to have anything but money, green money signs in their eyes. They're going to assess as much as they possibly can, regardless of whether it's truly owed, regardless of the circumstances. I just had a bad premonition that there would be auditors out there just digging up taxpayers left and right, pulling in as much revenues as they can and telling the taxpayer, all right, here's your assessment. We don't want to hear what you have to say. You have to go through the appeals process if you want to get it resolved. A lot of taxpayers, if the dollar wouldn't be high enough, wouldn't fight that, and they would just pay the tax due. So you'd have some headaches and nightmares out there, I think, if you actually had third-party auditors. Next one is the Hospital Utilization Project, commonly referred to as the HUP test, versus Act 55. Act 55 was a 5-part test that was legislated into law that determined if an entity was a purely public charity. So Act 55, you had 5-part test. You meet all the tests. You're purely public charity. You can be exempt for sales and use tax. You can be exempt for property tax purposes. It was nice to have that standard. There's some questions as to what truly passes those 5 tests, that 5-part test. So there was a case that came up, the Hospital Utilization Project, which took the 5-prong test and expanded upon it. It gave you specific examples as to what does and what does not meet the test. So at the end of the day, you can potentially have an entity, not an individual, pass Act 55, the original 5-prong test that was legislated into law. They can meet that test, but based upon the expanded verbiage and qualifications included under the HUP test, they could potentially not meet the HUP test and therefore not deemed to be a purely public charity. The legislature didn't like that too much. They viewed it as the judicial system passing their own legislation. So what we have now is there's some efforts to get a constitutional amendment, providing that, legislatures legislate and the judicial component basically reviews the legislature and makes decisions based upon the laws. They don't make up their own laws. So you'll be seeing and hearing more of that going down the road. And lastly, I think you'll be seeing something with regards to the business privilege tax clarification. Not sure if anyone has heard the Rendina case out there or several other cases. But what you have is localities are imposing a business privilege tax based upon different criteria. You have one locality doing it one way, another locality doing it another way. So there's a possibility a taxpayer could be subject to over 100% of the gross receipts in which they're bringing in. The resolution to that is there's one of 2 options that are currently being considered by the legislature. The one is basically coming up with a base of operations. Wherever your office is, that is where your gross receipts will be taxed based upon business privilege tax. The second alternative would be to have a set standard in which if you're in a location for over, I believe it's 15 days, if you're in that location for over that set amount of time, you could be subject to that jurisdiction's business privilege tax. I think the first one, the base of operations, would be the best route. A lot of localities think that they'd be losing out on money that they're currently receiving. So I think at the end of the day, you might be looking at a specific defined bright line test as to how many days you can be in a locality before they can subject you to their business privilege tax. Okay, and up next and finishing off the webinar today is potential tax issues that we see going forward. I'm sure everyone's been hearing this for many, many years, but property tax reform is always a hot topic. Problem with that is some of the proposals out there to do away with property tax is not the best the best route of going about it. There's talk of increasing the personal income tax rate to over 4%. So that'd be a very high percentage increase of the personal income tax here in PA. There's also talk of increasing the sales tax. That's the next item. Increasing the sales tax by expanding the base to include all services. Those just kind of scare me. Not just the fact that I don't want to add sales tax to my bills. They're hard enough to send out and explain as it is. But I just think if you go in to start taxing services, it's just a snowball effect. And at the end of the day, especially for, unless they have a business-to-business exemption, at the end of the day, it's just going to snowball. And at the end of the day, the individual is going to be paying a much higher tax for goods and services. Another item that's always seemed to be a hot topic is combined reporting for corporate net income tax purposes. Hopefully with the add back legislation, the combined reporting will lose a little bit of the steam. The thought behind combined reporting was that it would be a way to do away with the intangible holding company, the Delaware loophole. But now that we have add back, I'm really hoping that the combined reporting kind of dies off, because I think it would be pretty difficult for combined reporting for the Department of Revenue and for practitioners and taxpayers, at least in the short run. I think it would be pretty difficult to make that switch and conversion. Going to end this off here and pass it over to Reed to provide some CPE information, and then we'll open it up for some questions.
Okay, it looks like I ran over on time a little bit. I apologize for that, but there is one question I wanted to touch on real quick. Someone wanted to know the status of the corporate loans tax repeal. That was actually passed. PA Senate Bill 591 was actually passed by both the House and the Senate and was presented to the governor's office yesterday. I was thinking by the end of today we'd have that signed into law, but I'm hoping maybe tomorrow it will be finalized and we'll have a new law with regards to that as well. So once again, thank you so much for your time. If there's any questions or concerns, please feel free to reach out to me directly. My contact information is provided on the webinar right there. So feel free to shoot me an email or give me a call with any questions or concerns. Have a great rest of the day.
Thank you once again for joining us for this presentation produced by McKonly Asbury, Certified Public Accountants. We hope you join us and participate in our upcoming events. You can stay up to date with news and learn about our upcoming events by visiting us online at www.macpas.com. Thanks again and have a great day.